Welcome back to the deep dive. We have a really interesting puzzle to solve today.
We really do. It completely defies the usual gravity of the banking world.
Exactly, because we're looking at the National Bank of Canada's Q1 2026 earnings report. And look, usually bank earnings are pretty standard fare.
Right, you get some interest income.
You pay some expenses, you go home. But this one, it creates a bit of a paradox.
It's one of those quarters where you really have to double check the numbers to make sure you're reading them right.
Right, because here's the context for everyone listening today. National Bank is currently in the middle of digesting Canadian Western Bank, or CWB.
Which is a massive acquisition.
Massive. And usually when a bank buys another bank, things get messy. I mean, it's basically a law of nature.
Absolutely.
Costs go up, profits get squeezed, systems crash, and management gets on the conference call and says something like, hey, bear with us, we're integrating, it's going to be ugly for a bit.
Right, you expect that integration drag. It's the standard indigestion phase.
Exactly.
You're spending a fortune today to hopefully save money tomorrow. It's like buying a fixer-upper house. You expect to live in dust for 6 months before it looks good.
But National Bank just released their Q1 numbers. This was on February 25th. And they didn't just survive the indigestion.
No, they didn't.
They beat expectations. And then they actually raised their future performance targets.
Which is wild.
It's like they're eating a massive steak dinner while running a marathon, and they just decided to sprint the last mile.
That is a great way to put it.
So the mission for today's deep dive is to figure out how. How are they pulling this off? We're pulling from the Q1 earnings report, the conference call transcript from yesterday, and the investor slide deck. Let's get into it.
It really is a fascinating case study in execution. But before we get to the how, we need to set the stage properly for you.
Right.
It's late February 2026. The economic backdrop isn't exactly a party right now.
Not at all.
We've got trade tensions bubbling up, uncertainty around the CUSMA trade agreement, and the CEO, Laurent Ferreira, was actually quite blunt about the macro environment on the call.
Yeah, he was.
He said the Canadian economy is currently performing, quote, far from its potential.
Which is a very polite Canadian CEO way of saying the economy is sluggish.
Very sluggish. And yet, in that environment where the wind is blowing right in their face, National Bank is putting up some very green numbers.
Let's hit those headline numbers first. What are the core stats that everyone on Bay Street is reacting to?
So earnings per share EPS came in at $3.25.
Okay.
That is up 11% year over year.
Wow. Double-digit growth in a sluggish economy is already impressive.
It is. But the number that really matters here, the one the street really cares about, is the ROE, the return on equity.
Right, which tells us how efficiently they are using shareholders' money.
Exactly. It hit 16.6%.
16.6% is a solid number in literally any market.
Yeah, but the surprise wasn't just what they did in Q1, it was what they said they're going to do next.
Because usually after a beat, you try to lower expectations so you can beat them again next quarter.
That's the classic game. But they didn't play it. Management didn't just say, good job, team. They moved the goalposts further out.
Right.
Previously, their 2026 ROE target was around 15%. They've bumped that up to roughly 16%.
And looking further out to 2027.
They are outlining a concrete mathematical path to over 17%.
Wow.
For a bank of this size, moving the ROE needle by a full percentage point is a massive undertaking. It's like turning an ocean liner. It usually takes time and a lot of energy.
It implies they are finding money somewhere. And actually, speaking of finding money, I saw a detail about the share buyback program that seemed really counterintuitive to me.
The NCIB?
Right, the normal course issuer bid.
Yeah.
Basically, the bank buying its own stock back.
Yeah, they announced they are upsizing it. They want to repurchase up to 14.5 million shares.
14.5 million.
Yeah, they had already bought back about 6.4 million, but they want to do more.
Okay, hold on. Let's unpack the logic here for a second, because this is where I get stuck.
Sure.
They just bought Canadian Western Bank, which costs billions.
Yep.
They are closing a deal with Laurentian Bank later this year, which also costs money.
Right.
And they are still saying, we have so much cash left over, we're going to buy back our own stock. How is that physically possible?
It signals immense capital confidence. It really comes down to their CET1 ratio.
Break that down for us. CET1.
Sure. Common Equity Tier 1. Think of it as the bank's emergency fund. It's the capital buffer that regulators require them to hold to absorb potential losses.
Okay.
Regulators usually want this around 11% or maybe 11.5%. National Bank is sitting at 13.7%.
So they are wildly overcapitalized. They basically have too much cash in the vault.
They are swimming in capital. They actually want to get that down towards 13% by the end of 2027. So essentially, they have too much money. Even while funding these massive growth projects, it's a flex.
It really is a flex.
It tells the market, we can fund the merger, grow the business, and still return cash to you. Most banks hoard cash during a merger just in case something breaks. National Bank is doing the exact opposite.
Let's talk about that merger itself, the Canadian Western Bank, or CWB, integration.
Yeah.
You mentioned earlier that acquisitions usually cause indigestion.
Always.
Why is this one different? Is it just luck?
It's not luck at all, it's speed. This is the real aha moment in the transcript for me. They are significantly ahead of schedule.
Okay.
When they announced this deal, they set targets for synergies.
Which is corporate speed for cost cutting, usually, like firing people and closing duplicate branches.
Mostly, yes. But also removing duplicate IT systems, combining back office functions, renegotiating vendor contracts. Their year one target for these savings was CAD $135 million.
And where are they now?
They've already realized CAD $176 million.
Wait, we were just in Q1, and they've already beaten the full year target.
Precisely. They are moving at warp speed. And here is a specific detail that really jumped out at me from the call.
What was it?
Judith Menard, one of the EVPs, mentioned that the systems conversion moving CWB clients onto National's platforms was finished just last weekend relative to the call.
That is terrifyingly fast. I mean, usually banking IT migrations are the stuff of nightmares.
Absolutely.
You hear about customers getting locked out of accounts, data getting lost, projects dragging on for 2 years.
And this one is done. The heavy lifting is completely over. Now look, speed has consequences. It wasn't entirely seamless in terms of retaining every single dollar.
Oh.
They noted that personal deposits were down about 1% sequentially.
Why is that? People got annoyed with the system switch and left.
Not necessarily annoyed, it's expected attrition. You have to understand CWB's old model.
Right.
They were a regional bank that often had to pay very high interest rates on deposits just to attract cash. They had a lot of rate shoppers.
Okay, and National Bank is a major player.
Exactly. They don't play that game. They don't need to pay top dollar for deposits. So as they integrated some of that hot money, the rate shoppers left to find a better yield elsewhere.
But management doesn't seem panicked about that at all.
No, they seem totally fine with it because while the hot money left, commercial deposit growth was actually strong.
The business clients.
Right. They're keeping the business clients, which are the relationships that actually matter for the long term. Losing a retail customer who only likes you for your high interest rate is fine.
But losing a business that uses you for payroll and loans is bad.
Exactly. And they kept the businesses.
So they cut the costs faster than expected. But you can't just cut your way to growth forever. Eventually you have to sell something.
That's true.
Are they making any new money from these new CWB clients?
That's the next phase. They call it revenue synergies. They are targeting CAD $50 million there.
Okay.
It's early days, but they are already starting to sell capital market solutions to those CWB clients.
Give us an example of what that actually looks like. Paint a picture for the listener.
Okay, imagine a mid-sized energy services company out in Alberta.
Right.
They used CWB for their loans because CWB was the local lender and knew the local market. But CWB was too small to help them if they wanted to, say, issue public debt or hedge their foreign exchange risk.
Or acquire a competitor down in Texas.
Exactly. CWB just didn't have that desk, but National Bank does. So now National Bank reps are going to these Alberta clients and saying, hey, we can handle your M&A and your hedging now. You don't need to call New York or Toronto. We're right here.
That makes total sense. That is a whole new revenue stream. It's cross-selling the big bank capabilities to the regional bank clients, bringing Wall Street to Main Street, Alberta.
You nailed it. And speaking of big bank capabilities, we need to talk about the different segments of the bank. Because reading through this report, it really feels like a tale of two cities. Or maybe a Ferrari and a fixer-upper.
I love that analogy. Let's start with the Ferrari. I assume that's capital markets.
Absolutely. This segment was on fire. Net income of CAD $443 million, which is up 6%. But the number that blew me away was the efficiency.
Yeah.
The implied ROE for this segment is in the mid-20s.
Mid-20s ROE.
In the banking world, that is massive. Most peers struggle to get that consistently. Usually, capital markets are volatile. It's feast or famine. Right now, it's a feast.
So what is the fuel for this Ferrari? Is it just that the stock market is generally up?
It's more specific than that. Etienne Dubuc, the head of capital markets, gave a really great explanation. He talked about pent-up demand.
Sure.
For the last year or so, companies have been sitting on the sidelines, kind of afraid of interest rates. Now they are ready to make moves.
Yeah.
Mergers and acquisitions, M&A, are spiking. He mentioned advisory and underwriting revenues were up over 30%.
30% is a huge jump for just one quarter.
It is. And he linked it to something really interesting, the federal budget priorities.
The government. Wait, how does the federal budget help an investment bank?
He suggests that companies are repositioning around strategic areas. Think defense, security, industrial strategy. The CEO, Laurent Ferreira, explicitly mentioned Canada's reindustrialization and economic sovereignty.
That's a pretty heavy concept.
It is, but think about it. If the Canadian government is pushing for more domestic manufacturing or energy security or building up defense capabilities, regardless of where you stand on the politics of it,
Right.
companies need capital to build that stuff. They need to buy other companies to get bigger. National Bank has clearly positioned itself to be the banker for that reindustrialization. They are riding a massive macro wave here.
Okay, so capital markets is the Ferrari speeding along on government strategy and M&A. But then we have the fixer-upper,
We do.
personal and commercial banking, or P&C. I'm looking at the numbers here, and, well, they aren't keeping up.
No, they aren't. The ROE for the Canadian P&C segment was around 13%.
Contextualize that for me. What are Royal Bank or TD doing in their retail networks?
The big players are typically running closer to 20%, sometimes even higher in good quarters. So 13% is, well, the CEO actually called it subpar.
He actually used that exact word.
He did. Laurent Ferreira was very direct. He didn't make excuses.
Yeah.
But, and this is the crucial part for anyone looking at this as an investor, he framed it as upside.
Meaning, we know it's bad, which means we can fix it and make more money.
Exactly. Look, if you're already at 22% ROE, it's incredibly hard to get to 24%. The sponge is basically squeezed dry.
Right.
But if you're at 13%, getting to 16% is very doable. They've launched a strategic review of the P&C sector. We don't know the full details yet, but the clear implication is they're going to find ways to be much more efficient.
Is the problem that they aren't growing? Because looking at the mortgage numbers, they seem oddly resilient.
That's the strange part. The growth is actually fine. Despite everyone talking about a housing slowdown, their personal mortgages grew 3% sequentially and 11% year over year.
11% growth in mortgages when interest rates have been high. That feels a bit risky. Are they just lending to anyone who walks in the door?
No, and this is where you have to understand the Quebec factor.
Oh, right.
We have to remember, National Bank is heavily weighted towards Quebec. About 53% of their portfolio is there. The Quebec market just behaves differently than Toronto or Vancouver.
How so?
It's far less volatile. Prices didn't skyrocket as much during the boom, so they haven't crashed as much during the correction. Delinquencies are historically lower.
That makes sense.
Plus, get this, 27% of their portfolio is insured, so they have this safety moat that allows them to grow even when banks in Toronto might be tapping the brakes. They are playing in a safer sandbox.
So the engine works, they can generate mortgages, they just need to tune the car for better efficiency.
Exactly.
Now let's talk about the thing that usually derails bank stocks. Risk. With the economy being far from potential, are they seeing people stop paying their bills?
Surprisingly, no. The provisions for credit losses, PCLs, came in at CAD $244 million. That's about 32 basis points.
That high? Low.
It's what you'd call stable. It's right in the middle of their guidance range of 25 to 35 basis points. It's a sleep well at night number.
Okay.
But what's truly fascinating is how conservative they are being about the future.
What do you mean by that?
Management explicitly stated that their 2027 targets, that path to 17% ROE we talked about earlier, assumes zero improvement in the credit environment.
Wait, really? So they aren't betting on the economy getting better?
Not at all. They are assuming trade tensions continue, CUSMA uncertainty drags on, and people keep struggling at the exact current rate. And they're saying, even if things stay this tough, we can still hit 17% ROE.
That is bold. It's basically saying, we don't need a tailwind, we can fly in a crosswind.
Exactly. And you see that discipline in their U.S. subsidiary, Credigy as well.
Right, Credigy. That's their specialty finance arm in the States. I saw a note that their growth slowed down a bit.
It did. The outlook for Q2 is a bit slower. But the reason is really telling. They said it was due to competitive pricing.
Meaning?
Basically, other lenders were willing to do deals for cheaper, taking lower returns.
So National Bank just walked away.
Yes. They looked at the deals and said, no thanks. We have pricing thresholds. If we can't make our return, we simply don't do the deal.
I love that. In a world where everyone is chasing growth at all costs, sometimes the absolute smartest move is to say no.
It protects the balance sheet. They'd rather grow slower and safe than fast and risky. That discipline is exactly why they have that massive capital buffer we talked about earlier. They don't gamble.
Okay, let's bring this all together. They have this slide in the deck. The waterfall?
Yes, the ROE waterfall.
It visualizes how they get from where they are now to that 17% plus ROE in 2027. I want you to walk us through the math because this is the real roadmap.
It's a very logical staircase. You start at the current level. Step 1 is organic earnings growth, just the core business growing naturally. They expect that to add about 110 basis points to the ROE.
Okay, so just doing what they do, but bigger.
Exactly. Step 2 is the CWB synergies. As they finish cutting those costs we discussed and boosting revenue from the new acquisition, that adds another 20 basis points.
Small, but helpful.
Yeah.
What about the other deal?
That's step 3, the Laurentian Bank transaction. This is expected to close in late 2026.
Right.
It's a smaller deal, mostly buying their commercial and retail portfolio, but it's highly accretive. That adds 30 basis points.
And the buybacks we talked about.
Step 4, reaching that target capital ratio of 13%. By buying back shares, they reduce the number of shares outstanding, which is the denominator in the ROE calculation. That boosts the number by 40 basis points.
So you add all that up, but there has to be a cost, right?
Yes.
Growth isn't free. You need to keep money to lend money.
Correct. The offset is the capital required to support growth, specifically risk-weighted assets or RWA growth. You had to set aside money to back new loans. That subtracts about 100 basis points.
So if we do the math, 110 plus 20 plus 30 plus 40,
My math's 100.
and you land comfortably above 17%.
And again, just to hammer this home for everyone, that math assumes the economy doesn't get any better.
Right.
And crucially, and this is the part that might actually be the most important takeaway of this deep dive, it assumes the P&C business, the fixer-upper, doesn't actually get fixed.
Wait, really? The waterfall doesn't include the strategic review.
That's correct. The CFO, Marie-Chantal Gingras, was extremely clear on the call. The waterfall assumes historical efficiency levels. It does not include potential upside from the P&C strategic plan.
So they are sandbagging.
It certainly looks like it.
Let's explain sandbagging for anyone not familiar with the term.
It's under-promising so you can over-deliver. They are telling the market, we can get to 17% ROE just by breathing. But they have this free option in their back pocket.
Right.
If that strategic review actually works, if they can close the gap between their 13% ROE in P&C and their peers' 20%, that 17% total ROE target is the floor, not the ceiling.
Wow. If they fix P&C, we could be talking about an 18 or 19% ROE bank.
Which would force the entire market to completely re-rate the stock. A bank that profitable trades at a much higher multiple.
So for everyone listening, here is the real takeaway. You're looking at a bank that is executing a complex merger much faster than anticipated.
Yep.
They have a capital markets division that is printing money on the back of government industrial strategy. And they have a mathematical roadmap to 17% ROE that doesn't even require them to fix their biggest weakness.
That's the summary. The question now is, can they execute the P&C fix?
That is the multi-billion-dollar question. But based on how fast they handled the CWB integration and the intense discipline they show in the U.S. with Credigy, I wouldn't bet against them.
Neither would I. It's a management team that seems to have a very clear grip on the levers of their business.
It's a fascinating look at a bank that seems to be firing on almost all cylinders, with a concrete plan to fix the one cylinder that isn't. Thank you all for listening to this deep dive into National Bank's Q1 2026.
It's been great.
Now, we want to leave you with a final thought to mull over. We know their 17% target assumes P&C stays stuck at historical levels. But if you're watching this stock, ask yourself, what if that strategic review actually brings them fully in line with their peers at 20%?
It changes the math completely.
Exactly. How high could that overall ROE number actually go? Is the real upside being drastically understated here? Keep an eye on how they execute this review in the coming quarters. We'll catch you on the next deep dive.
Looking forward to it.